Welcome back, everyone. Today we're diving into the Q3 2025 earnings from the pharmaceutical giant, Novo Nordisk. It was a quarter of solid growth, shadowed by a more cautious outlook, sending a clear message to investors about the challenges ahead. Let's break it down. Novo Nordisk, ticker NVO, is a leading global Danish pharmaceutical company, founded in 1923 and headquartered in Bagsværd, Denmark, with a primary focus on the discovery and development of innovative medicines. It holds a dominant and world-leading position in the treatment of diabetes, manufacturing and marketing a comprehensive portfolio of products, including modern insulin, GLP-1 receptor agonists, and other diabetes care solutions. Beyond diabetes, the company is also a key player in other serious chronic diseases, with a growing presence in areas such as obesity care, hemophilia management, growth disorders, and hormone replacement therapy. Guided by its strong triple bottom-line business principle, Novo Nordisk is committed to operating in a financially, socially, and environmentally responsible manner, striving for long-term value creation while making a significant impact on public health worldwide. First, the good news. For the first 9 months of 2025, Novo Nordisk delivered strong results, 15% sales growth and a 10% increase in operating profit. This was unsurprisingly driven by their blockbuster GLP-1 drugs for diabetes and obesity, Ozempic and Wegovy. In fact, sales of Wegovy specifically grew 18% year over year. However, and this is a key point, that number actually missed analyst estimates. Now, let's get to the heart of the market's reaction. The company did two things that caused its share price to drop around 3 to 4%. First, they narrowed their full-year guidance. Sales growth is now expected to be 8 to 11%, down from the previous range of 8 to 14%. More notably, operating profit growth was cut to 4 to 7%, down from 4 to 10%. So, why the pullback? Two main factors. Intensifying competition. Rivals, most notably Eli Lilly, are applying significant pressure in the GLP-1 market. U.S. pricing pressures. The company confirmed a deal with the U.S. government to reduce prices for its obesity drugs, a move that directly impacts revenue. In response to these headwinds, Novo Nordisk is launching a major company-wide transformation. They're focusing on cost-cutting, aiming for annual savings of about DKK 8 billion by the end of 2026, and sharpening their focus on core products. They're also continuing strategic acquisitions to fuel future growth. The short-term outlook is undoubtedly cautious. The guidance cut and pricing pressures are real concerns that will likely create volatility. However, many analysts see a compelling medium-term story. The new pricing agreement, while a hit to revenue per dose, could significantly expand patient access and drive volume growth in the massive obesity market. The fundamental demand for these drugs has not changed. Let's talk about the reasons for optimism. Despite the stock price pain, Novo's fundamental business still has powerful drivers. First, leadership in a massive market. Novo Nordisk remains the dominant player in the GLP-1 drug market. Demand for Wegovy and Ozempic is still incredibly strong, and this is a long-term growth story, not a fad. Second, innovation continues. The company isn't resting on their laurels. They're pouring money into R&D for next-generation treatments, including oral versions of GLP-1s, which could be a game-changer for patient convenience and market expansion. Strategic moves like the bid for Metsera show they're serious about strengthening their pipeline. And third, and perhaps most importantly, a major market expansion is on the horizon. The recent agreement to broaden access to obesity treatments for Medicare patients starting in 2026 is huge. While it may come with lower prices, the sheer volume of new potential patients could be a massive tailwind. And finally, many analysts point out that after this steep decline, the stock is looking relatively cheap. For long-term investors, this could be a classic case of buying a great company during a period of temporary pessimism. Now, let's address the elephant in the room, the very real challenges that have caused this sell-off. The number one issue is intense competition and pricing pressure. Eli Lilly is a formidable rival, and their drugs are gaining market share. In response, Novo was forced to make a deal to significantly slash the price of its obesity drugs in the U.S., a direct hit to its profitability. This leads to the second problem,
market share erosion. It's not just Lilly. Cheaper, compounded alternatives that aren't FDA approved are also stealing patients, squeezing Novo's sales from multiple angles. Third, the company is facing rising costs. They're undergoing restructuring, which includes workforce reductions, and investing heavily in their pipeline. These expenses are weighing on profits in the short term. And all of this is reflected in the company's own outlook. Novo Nordisk has been forced to lower its full-year 2025 sales and profit guidance, not once, but multiple times this year. This has shattered investor confidence and created significant uncertainty about its near-term growth trajectory. But for income investors, there's another compelling story here: the company's dividend. Is Novo Nordisk a hidden gem for dividend growth? Let's break it down. Novo Nordisk isn't just a recent player in the dividend game. This is a company with a proven track record. We're talking over 26 years of not just paying dividends, but consistently increasing them. And we're not talking about small bumps. Over the past decade, the average dividend growth rate has been absolutely stellar, sitting in the range of 23 to 30% annually. That's a pace that few companies in any sector can match. Now, let's talk about the current situation. For the 2025 financial year, the company has already paid an interim dividend of 3.75 Danish krone per share back in August. The final ordinary dividend is expected to be paid in March 2026. So the big question is, how safe is this dividend? This is where Novo Nordisk really shines. The company maintains a moderate payout ratio of around 35%. What does that mean? It means that for every dollar of profit, Novo Nordisk only pays out about 35 cents in dividends. The rest is reinvested back into the business. This low ratio is a strong signal of dividend safety, telling us that the payments are very well covered by earnings, and there's a significant cushion even if earnings face temporary pressure. For investors looking for income, the current yield is approximately 3.5%. In today's market, and especially when compared to the broader pharmaceutical and healthcare sector, that is a very attractive yield.
Now, what are the analysts saying? The general consensus is that Novo Nordisk's dividend is very safe, backed by its solid earnings and strong cash flow from its key products. However, they do point to some headwinds, things like competitive pressures and regulatory scrutiny, that might put some downward pressure on the company's explosive growth and, by extension, the pace of future dividend increases. Novo Nordisk presents a compelling case. You have a strong and attractive yield of 3.5%, a proven history of robust growth, and a very safe payout ratio. While near-term dividend growth might be more cautious, the company's fundamental strength and commitment to returning capital to shareholders suggest there is a very good possibility for continued increases in the coming years. The overall picture from Wall Street is generally positive. The consensus rating for Novo Nordisk leans strongly towards buy. But let's break down the numbers. Out of the numerous analysts covering the stock, around 20 are recommending a buy, while 9 suggest hold and only 2 are advising to sell. This shows a clear bullish bias among the experts who follow the company day in and day out. This optimism is reflected in the price targets. The average range sits between $59 and $80 per share. From current levels, this implies a significant upside potential of 40 to a whopping 70% over the next 1 to 2 years. This suggests that many analysts believe the recent decline has created a buying window, viewing the stock as undervalued. This confidence isn't just a feeling, it's backed by recent action. Prominent firms like HSBC and Berenberg have recently upgraded their ratings, moving from hold to buy or strong buy. Their upgrades are driven by a strong belief in Novo Nordisk's long-term growth potential, even as the company navigates some near-term challenges. To wrap it up, the dominant analyst opinion is clear. Novo Nordisk is a buy or hold with significant upside potential. The final takeaway for investors is this: you have to weigh the company's strong fundamentals, market leadership, and exciting pipeline against the very real near-term uncertainties like competition and pricing. It appears that Wall Street believes the long-term growth story is intact and that the current price could be an attractive entry point. What's your take on Novo Nordisk? Are you buying the dip or are you waiting on the sidelines? Let us know in the comments below. And don't forget to like and subscribe for more deep dives. Thanks for watching.